Leadership Alpha is based on understanding how CEOs create or destroy shareholder value. We can model every variable: sales price, units sold, input costs, consumer trends. We dig below the surface. The mindset, the relationships, the true capabilities that determine whether a CEO can execute. Leadership analysis only creates value when it connects to the fundamentals. When you synthesize leadership and fundamentals, you stop investing in what companies are. So whether you lead a public company or a private one, large or small, or even a family or a team, the principle is the same. And so they go down the list, and the women are like, I want the experience. You know, ex-Wall Street Journal investigative journalists who've been in the business for 20 plus years, asking the questions and pulling the threads. Everyone in this room has lived this story or something like it. You've analyzed the numbers, the strategy, the market share, and everything looked solid. Then a CEO changed. Within months, even weeks, something felt different. The tone, the energy, the outcomes. And before markets caught on, you could already sense it. Something fundamental had shifted. That's because markets price information, but they don't always value judgment. And leadership, well, leadership is judgment. It's how capital gets allocated, it's how people are motivated, and it's how strategies actually become results. At Eagle Talon, we focus on what we call leadership alpha. It's a measure of excess returns attributable to having the right leadership team in place. And for all my crypto friends in the audience, no, this can't be tokenized. Leadership alpha is based on understanding how CEOs create or destroy shareholder value. Because behind every market outcome, there's a leadership decision. And the market, time and again, underestimates how much that matters. Think about it. We can model every variable: sales price, units sold, input costs, consumer trends. But when the wrong CEO runs a company, the assumptions unravel. Conversely, when the right leader is in the right seat at the right time, the company turns into a compounder. So, how do we do it? Well, we evaluate CEOs the way others evaluate companies. We apply the same rigor, deep research, validated by multiple sources, and quantitative discipline, but through the lens of analyzing human behavior. Our team includes not just investment analysts, but investigative journalists and intelligence professionals, people who know how to separate narrative from fact. Because the truth is, most investors, they stop at the resume. We dig below the surface, the mindset, the relationships, the true capabilities that determine whether a CEO can execute. And we're not just studying companies. We're studying the humans who drive decisions and actions that make or break the companies. And that's what's fascinating. This approach is as old as human behavior itself. And the inefficiency will continue to persist. Everyone agrees leadership matters, but few have a system for measuring it. And that's where the alpha hides. Let's start with a simple observation. The market knows when a CEO changes. It's publicly available information. But what the market rarely knows is what the change truly means for the company. We've studied over 20 years of CEO changes, thousands of data points, and the pattern is clear. In the first 2 years, after a new external CEO comes into a company, the top quartile outperforms the market by more than 80 percentage points, 8-0. The bottom quartile underperforms the market by almost 50 percentage points. Okay? So if the S&P is up 20% over 2 years, those outperformers are up 100. They double. The bottom quartile, if the S&P is up 20, they're down 30. That's massive dispersion and a massive pool of alpha deficient. Clearly, external CEO changes create inflection points, and markets underestimate the impact. Why? Because traditional analysis is built for financial statements, SEC filings, company presentations. It's not built to quantify the effect of human leadership on value creation. The irony is, research shows that leadership explains 1/4 to 1/2 of company outcomes. Markets chase what they can measure: earnings, margins, multiples. But leadership, it's harder. It's judgment. It's pattern recognition. It's understanding whether this person's skill set and temperament actually fit what the business needs right now. So let's look at 2 real-life examples. These demonstrate how important the CEO is to value creation. So on the left graph, you'll see CSX, the railroad. What this graph represents is that big gap up on the left side. That's when the Wall Street Journal published an article that rumored that veteran railroad operator Hunter Harrison would step in as CEO. Just on the rumor, okay, no one could capture this because it happened pre-market. Just on the rumor from a credible source, the stock gapped up 25%. Of course, no one could have captured that gain, as I said, but over the next 47 days, the stock ended up 35%. That created more than $11 billion of shareholder value. On the right graph, when Brian Niccol left Taco Bell to lead a turnaround at Chipotle, the stock gapped up 16%. Within 90 days, the stock was up 67% and created $5 billion of value. In both these cases were the same companies, the same systems, the same challenges. All that changed was they had a new leader. What investors recognized, though, was that these 2 leaders understood exactly what their companies needed and how to deliver it. And this is what we call leadership alpha. The excess return created when the right leader is in the right seat at the right time. So why did the stocks gap up on the open? Specifically, both CEOs had previously created massive shareholder value. Harrison had built and refined his playbook while turning around 3 railroads. Niccol had driven growth and innovation at Taco Bell. In both cases, their success wasn't random. It was consistent with who they were as leaders. And I believe history doesn't repeat, it rhymes. And so do leadership patterns. So back to the CSX and Chipotle stock performance. How did they do over the next 3 years? Well, CSX tripled over less than 3 years. Chipotle was a 6-bagger. It was up 6 times. You made 6 times your money in about 3.5 years. And that's our approach at Eagle Talon. We believe every stock in our portfolio is at least a double over the next 3 years. If it's not in our portfolio. These are multi-year transformations, where the market finally catches up with the leadership signals. And that's the key insight. When the right leader is in the right seat at the right time, value compounds. And the leadership signal, it always shows up. Investors just rarely recognize it early enough. So what makes CEO change, So what makes CEO change powerful to investors is how consistently the universe renews itself. Every transition resets a company's trajectory, for better or worse. Overlay that on business cycles and market cycles, and each leadership change signals a new opportunity. So my question to you here is, what's the average tenure of a CEO? Is it less than 2 years? Is it 4 years, 7 years, or 10? So how many people think it's less than 2 years? Okay. How many people think it's 4 years? All right. 7? Okay. And 10? No one. Okay. So most of the votes came in the middle, and the answer is actually 7 years. So what that means is, every year, 15% of all CEOs are turning over. In the Russell 1000, that means every year, 150 companies change CEOs. And approximately 1/3 of these are external CEOs. They come from outside the business. Very few investors specialize in this discipline. And that's despite it being a persistent, underfollowed source of alpha. So you might be asking why. It's because it's expensive to do it right. It's complex to analyze. And most firms, they're built to analyze numbers, not people. But that, right there, is precisely why it works. Market inefficiencies, where alpha is created, is where others can't or won't go. So we're not looking to buy or sell every CEO change. We're looking for the ones that matter, the ones where leadership fit, company opportunity, and timing converge. Every year, we narrow the universe of 50 new external CEO transitions to a handful of high-conviction opportunities where the leadership signal is clearest. Our process is comprised of 3 layers. Most investors focus primarily on that first layer, the one labeled number 1. That's the company. Management quality is just a checklist at the end of their process. As you're seeing, we take a different approach. We begin with the leaders. In addition to our best-in-class fundamental research on companies, we have 2 additional layers focused on the people who are making the decisions. In the second layer, our investigative journalists conduct interviews with people who've worked with the CEOs, typically from college until current. So you get a 360-degree view, time-weighted, of how they've evolved as leaders and as managers. And as you know, there's a difference between leaders and managers. Ultimately, what we want to know is, does the CEO's expertise and track record match the company's needs at this stage of its life cycle? And whether the CEO accomplished what they say they did. In the third layer, our former intelligence and law enforcement officers conduct a deep background check to see if they walk the talk. Now, this isn't just career and education. We're searching for evidence of a criminal record. We're searching for a history of civil litigation, because that provides insight into their personality and their fit with company culture. We believe that the way people manage their personal lives is the way that they'll manage their businesses. So we also look at, what cars do they drive? What homes do they own? How much personal leverage do they employ? What's their family tree look like? Who are their parents, their siblings, their children? We look for evidence of substance abuse, marital strife, illnesses in the family. And illnesses in the family is a great example of how all of these data points fit together. Because if we find an illness, we're not sure what it means. But what we can do is insert that question with our investigative journalists, and by the end of the process, we have a pretty good sense of whether it's going to distract them or make them more empathetic leaders. We then combine all of this qualitative data and we quantify it. We reflect it in our financial models, and we assess our playbook for value creation and probability of success. Then we go long the value creators, and we short or avoid the value destroyers. So everything we've discussed so far, the interviews, the investigative work, the leadership mapping, it all comes to life here. Because at the end of the day, leadership analysis only creates value when it connects to the fundamentals. Traditional investing starts with fundamentals, margins, returns, capital efficiency. We start one level higher with the decision makers who are responsible for producing those fundamentals. We synthesize what we've learned about a CEO's skills, mindset, and decision patterns, and overlay these onto our financial models. For example, if we see a pattern of strong execution through cycles, well, we can model through volatility with higher confidence. In other words, leadership tells us which numbers to trust and where to push our model. It's how we turn a qualitative edge into a quantitative edge. When you synthesize leadership and fundamentals, you stop investing in what companies are, and you start investing in what they're capable of becoming. So this is really the core of how we evaluate leadership fit. We build conviction layer by layer because every data point tells part of the story. So let's go through a case study. At the time Margot Georgiadis was appointed CEO, Mattel had lost nearly half of its value in just over 3 years. About $7 billion of market cap erased under prior leadership. The board, it was under pressure, as you would expect, to find a change agent, a new CEO who could transform the company, restore confidence, and rebuild trust. Let's walk through Mattel the way we analyzed it real time. Margot's marching orders were simple. Become more like Hasbro. Hasbro had created blockbuster movies and video games based on its brands. It had created a flywheel. As a result, Hasbro's stock price had doubled. Meanwhile, over the same period of 3 years, Mattel's stock price was down 18%. Margot's resume, it checked all the boxes. Harvard, McKinsey partner and head of both consumer and restructuring. Google, president of the Americas. Strategy, analytics, digital, all ideal skill sets to drive a digital transformation. If you were on the board and you had this resume in front of you, would you have hired her? Most people would have. Makes sense. Then we looked at compensation. Her pay package, $37 million, 3 times the prior CEO's pay. But when you look deeper, over 90% was tied to long-term performance and equity awards. Do you think that's enough motivation for her to move quickly and execute? Probably. Next, the board. Up to this point, most of what I've shown you is publicly available. Filings, footnotes, the kind of information any analyst could piece together with enough effort. But to understand the deeper relationships, we had to go further. We mapped board overlaps using multiple sources, a process that's complex, time-consuming, and not something most investors take on. Then we layered in insights from our interviews. What we found was telling. Several directors already knew Margot from prior companies and shared board service. During her time at McKinsey, she'd actually worked closely with Mattel's current COO for more than a year on a digital transformation mandate. What we're doing here is connecting the dots. We're looking at how relationships and prior work histories might shape decision-making dynamics in the boardroom. It's another layer of context to help evaluate fit. When you look at Mattel's roadmap on the left versus Margot's resume on the right, side by side, it all makes sense. Mattel's roadmap called for renewed vision, digital transformation, restructuring, a cultural reset, and Margot brought exactly that skill set from McKinsey, Google, and Discovery. So here I'd like you to take a couple of minutes and discuss with the person next to you, based on what we've seen so far, would you have hired her? Then we'll do a quick vote.
Ding, 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 ding. Ding, 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 ding.
All right. You guys come up with your answer? All right, how many people would have hired her? All right, how many people would not have hired her? All right, looks like a little bit more would have hired her. But that's exactly the point. And a lot of you didn't raise your hands. You'll fix that for the next interactive slide, right? The information so far could lead reasonable people to different conclusions. So to understand whether her skills actually match the company's culture, the stage of its life cycle, and the mission, let's move to our next layer of analysis, the background check. Ooh. All right, our investigative review surfaces filings, what filings can't show, which are indicators of behavioral patterns. What we found was that her compensation package equates to 1/3 of her pre-tax lifetime earnings. That's significant, right? But compensation was not as closely linked to value creation as it appears on the surface. Does that change your confidence in whether she'll execute? All right, everyone has to raise their hand here if this happens. So quick show of hands. How many people here have ever worked with an executive coach? All right, fair number. I do too, by the way. And was that something, you don't have to answer this one, was that something you chose or something the organization required? In Margot's case, she was required to work with both an executive coach and an image coach as a condition for continued advancement at her company. That detail stood out, not because coaching is uncommon, but because of why it was mandated. It hinted at underlying challenges around collaboration and communication with peers. Would any of that change your confidence in her as a transformational leader? During her tenure at Discover, litigation records revealed her involvement in a marketing program that regulators later determined to be deceptive in its presentation to consumers. It raised questions about oversight and judgment, about how decisions were made and by whom. When you're evaluating leadership, how do you factor in patterns like this? Do they speak to integrity, to governance, to culture? Now, We even came across a detail that's maybe not what you'd expect in a CEO background dossier, especially for a relatively high-profile CEO. Someone in her family owns a motorcycle. We couldn't confirm whether she's the rider, though she does have at least one minor traffic violation on record, a speeding ticket. Now that may sound trivial, but details like this help us understand personality, risk tolerance, and behavior under pressure. All right, another interactive slide, so let's see more hands up. Now that you've seen what we've uncovered through the background check, a deeper, non-public layer, let's revisit your earlier decision. By a show of hands, based on everything you know now, would you have made the hire? How many people would have made the hire? Okay, how many people would not have made the hire? All right, that's a pretty big, so we probably went from to about a tenth of the room will make a hire and probably half would not. The goal here isn't to determine whether you're right or wrong. It's to see how additional information can sharpen or change conviction. And this is why we go deeper. Because every new layer either reinforces the thesis or it challenges it. We've examined the public data and reviewed the background check findings. Now we're going to move to layer 3 of the analysis, the interviews. This is where we test everything we've learned so far against first-hand accounts. We hear directly from people who actually worked with her. So from these conversations, a few clear themes emerged. She was a first-time CEO. The background check had already raised questions around integrity and character, and several non-board sources offered contrasting views. Let's look at 2 representative quotes from former colleagues. She knew how her bread was buttered and who would butter it. And she played politics well with people above her. Second quote, she would essentially purposely make some of these people look bad in front of their boss. These quotations help explain why what looked strong on paper didn't translate in practice. Here's what we began to hear consistently from people who had worked closely with Margot. She was great at managing up, but she was horrible at managing across and down. Collaboration and communication was often strained. A former colleague described her this way. You need to surround her with smart people, as I was saying, visionary people, or these other ones who can do it, but also those who can actually operate with her and would be okay with the mercurial sense or just her way of operating. I think that could be a bit of an Achilles heel that I don't think you can fix. Again, this is the kind of insight you never find in filings or press releases. Clearly, she was not someone who could mobilize teams behind a new mission. A new vision. Another consistent thing that emerged from the interviews, Mattel needed a transformative leader, someone who could reimagine brands, inspire creativity, and rebuild culture. But Margot's background was rooted in operations, analytics, and efficiency. Exceptional skills, but not what Mattel needed. One former colleague described it this way. In fairness, they brought her back to Google for a reason. They were like, you're here for results, and culture, fit, or whatever, be damned. That's what she was here for. Her strengths were optimized for scaling and structure, not for creative reinvention. The final theme that surfaced from our interviews was environment. Google. It's a well-oiled machine. It's a virtual monopoly with almost unlimited resources. But that environment can also mask weaknesses that only appear when resources are constrained. A board member and longtime friend said, "I think the things to watch for is this. If I were to look at blind spots, dealing with capital structure, dealing with finance is not something she's got deep experience in. She's never had to worry about those things." It's a pattern we see often. Success in one environment doesn't always translate cleanly into another, especially when it requires a completely different type of problem solving. All right, so I want to see hands again. Now that we've seen all three layers, the public data, the background check, and the interviews, by a show of hands, how many of you would buy the stock? Anyone? Wow. Can we hold it to the end? How many would short the stock? Okay, and how many would avoid it? All right, a lot of people avoiding the stock. But we have some short sellers here. I like it. Here's where all the pieces fit together. The board, this is our investment thesis, by the way. The board had a poor track record hiring the CEO, the right CEO. The prior two leaders had already destroyed $6.7 billion of shareholder value. Rather than changing how they made decisions, the board repeated the same process. Margot, well, she was a first CEO with the wrong expertise and the wrong match. Not creative, could only manage up. And if you think about what her skill set was, it's managing up, not down or across. Mattel is filled with C players, not the A players that you find at Harvard Business School and McKinsey and Google. So now she actually has to lead a team of C players. She can't do it. Digital transformation. Both the board and the CEO lacked the experience. And what was really telling at the beginning was when we looked at the board composition, Mattel had how many board members who were focused on media or tech? It was one. How many did Hasbro have? 6. 6 board members at Hasbro. No wonder they could create a flywheel. The company was in structural decline, and pressure was applied on a time horizon basis because they had a seasonal sales cycle, and she had a limited amount of time to change the business. So what was the outcome? 15 months later, the market caught up to our analysis. Mattel's stock fell 43%. She erased $6 billion of shareholder value in 15 months. The leadership signal, it had been there all along. We made a 31% return, created 40% alpha by shorting the stock. Annualized, our return was 43%, our alpha was 55%. The return, it was cycle resilient, and it was uncorrelated to markets. Hasbro was only down 5%. The Russell 1000 equal weight was up 13, and the consumer discretionary index was up 25. So that's the essence of what we look for. The right leader in the right seat at the right time. And when those three elements line up, value compounds. When they don't, it erodes. So whether you lead a public company or a private one, large or small, or even a family or a team, the principle is the same. And it starts with a mirror. Ask yourself, am I living my principles? Because you can't judge a leader by their resume or the narrative. You have to understand the person, their judgment, their energy, and their fit for what's truly needed right now. I'm Kareem Mauji, Chief Investment Officer of Eagle Talent Partners. We invest in companies led by the right leader, sitting in the right seat at the right time. Thank you, and I'll take questions.
Wow.
Do we have a microphone for questions?
Yeah, we do.
I'm sorry? She may know it now. No, so all of our work is done below the radar. So that's why we have this team of investigative journalists and former intelligence officers. So my view is this, okay? If you're the CEO of a public company, it doesn't matter what your competence is, whether it's finance, whether it's technology, whether it's marketing. The reality is, to become CEO, you have to be an extraordinary salesperson. And I don't actually want to talk to those people because they'll be able to convince me of whatever they want to. So we actually find all the data points in a constellation around these people, and we make our own decisions based on that.
Now, do you know who the original search firm was that did this search? Was it Korn Ferry or?
I did. I don't recall right now. I think it might have been Spencer Stewart, but I don't recall.
Okay. Did they have a requirement for a gender hire?
I don't know that, but it's interesting with the search firms. If you look at their mandates, okay, there's always time pressure, right? They always want, the board always wants the CEO yesterday. Yeah. And so what ends up happening typically is they don't hire the right person for the job, they hire the right person who's available right now. The best person available right now, not the best person.
Can I ask you a question about how you do your research? Like, love the use case, but how do you account for the gender bias? Because I mean, it's statistically proven that even in like reviews or like generally speaking, when there is female versus male person at executive position, there is enormous bias towards female leadership. So how do you incorporate that in your research and in your in your analysis?
So you're asking about the choices that it's shifting more towards female leadership, or the fact that that she failed and others fail?
Yeah, it's bias toward the leadership style, towards like her past experiences, like when you run this interview, when you overall running your analysis on the person.
Okay, I think I understand your question. So what I'll say is, look, our mandate is not to make sure there's gender equality or anything like that. We're just assessing it, okay? And so one thing that has kind of shaped the business world today is that, and you see this, you'll see it with Marissa Mayer from Yahoo, for example, and there are a lot of other women like this. What has happened is that a CEO job vacates, and the search firms will go out to all these people. And what happens is, often, historically, it's gone to the offer has gone to the males first, okay? Because they have the most experience. They've built the most experience. They have the most skill sets. And some of them, these turnarounds are just so messy, the guys say no. And so they go down the list, and the women are like, I want the experience, right? In their view, now I've become, even if I fail, I've become CEO of a public company. It makes it easier for my next role. And so there's been a lot of research that's shown that women, I don't know how long ago this was, but it probably was in the last 5 years that the survey and the study was done, but that a disproportionate of number of roles at that point that women ended up with were these really tough restructuring situations. That's what we do. This isn't an algorithm. We do have algorithms, but this isn't an algorithm. This is real human intelligence. This is former intelligence officers gathering information. This is, ex-Wall Street Journal investigative journalists who've been in the business for 20 plus years asking the questions and pulling the threads. This is experienced investment staff actually taking the data points and connecting them to see what the real, putting the puzzle together.
I see a question over there, Kareem.
Yeah,
Yes.
I'll stand up so you don't have to repeat it. So I'm very curious. So first of all, thanks for a great presentation and a very novel way of looking at this. How long do you allow to do this analysis? Because from it's announced till you're going to be a stock impact, you don't have that much time probably. And also, when you're doing these interviews, how many do you do, and what's the filtering mechanism so you don't just get a bunch of "I didn't like her" kind of noise, because it must be quite of a noisy thing.
Yeah. No, great questions. So you actually have more time than you think in order to figure out whether the CEO is a good fit. What we found is that most of the returns in a 2-year period come in the last 18 to 21 months. Okay, so you have 3 to 6 months generally before the stock moves a lot to figure out if they're the right person. In terms of the interviews, I don't mind sharing it with you because it's very difficult to replicate. All right, we start with between 500 and 1,000 people, and we figure out which of those people worked with the CEO at that time in the right areas, in the right office buildings, on the right floors, right, in the right divisions that might have interacted with them, and then we will select a subset of those. And then we'll go out to them, and we have a good mix of sources that we speak to. Yeah.
Let's give Kareem a round of applause. Thank you very much, Kareem.